Johnson & Johnson, my number one favorite dividend stock of all time, and the largest position in my personal dividend stock portfolio. I want to talk about Johnson & Johnson today, and I want to use it as an example because I get this question all of the time from subscribers. Ian, why is the number one position in your portfolio paying an unsustainable dividend? Ian, why do you invest in this company despite it having a huge PE ratio? What is it about this company, Ian? It seems like the metrics are bad. Today I want to take a deep dive into some of the J&J metrics. I've got them over here, and I want to share why the metrics that a lot of investors pull from popular websites online, those metrics can be very misleading, very misleading. And so I want to take an opportunity today to illustrate why these metrics oftentimes are the wrong metrics to be looking at. I want to share how to pull the right metrics and how I personally analyze a stock like Johnson & Johnson. By the way, I've got a bunch of their products over here. I love this company because their business spans consumer products, medical devices, and pharmaceuticals. And in the consumer product space, they own Band-Aid, and you might not know, but they also own Neutrogena. So check this out. This is some Neutrogena Beach Defense here. You guys know, if you've been following my channel for a while, that I like to visit Hawaii. It's one of my favorite places on earth. And when I go to Hawaii, I'm out on the beach. I want to make sure I have a fun vacation and I protect my skin while spending time in the outdoors. Well, where do I turn? I turn to Neutrogena. And so that is the true thug life. That is the true dividend life, because when I'm out there on the beach enjoying the sun, my dividends, they continue to roll in. When I'm sleeping in, I'm getting a lot of rest in Hawaii. I'm not actively working for my income. My dividends, they're still coming in. Compliments of Johnson & Johnson and brands like Neutrogena. So anyways, I want to jump into today's video. I'm really excited about it because I've been receiving this question for a long time. And so get ready for some dividend investing education. All right, everyone. So first, some background. Let's just look at these numbers. Currently, J&J, it's at $129.96 per share. When I go to a website like Yahoo Finance and I look at the earnings per share for the trailing 12 months, it's a really low 57 cents per share. And the dividend is 90 cents per share per quarter, or $3.60 per year. So if I take the 90, I multiply by 4, it comes out to $3.60 per year. And so a lot of subscribers, they look at something like this and they're like, Ian, you're crazy. Why is this your number one stock? If I take this price and I divide it by the earnings, 129 divided by the 57 cents, the PE ratio is a crazy 228. And a lot of subscribers come to me and they say, Ian, this PE ratio of 228, why would you invest in that? That is reminiscent of the very high PE ratios that tech companies used to have in the 1999 dot-com bubble days. Ian, what are you thinking? And then they go on to say, hey, look at the payout ratio. If I take $3.60, which is the current dividend, I divide by the earnings per share, which is this 57 cents, I get a payout ratio of 632%. In other words, they are paying out more money than they are bringing in. Again, subscribers say, Ian, this is not sustainable. And so anyways, that's the background where people are coming from. They're looking at Yahoo Finance, they're looking at other websites to pull data, and the data is making this company look bad from a financial perspective. I want to share today how I look at the data myself and why this data is wrong. And so moving on here, there's this concept called GAAP, Generally Accepted Accounting Principles. And when a website like Yahoo Finance portrays numbers, they're just pulling the GAAP numbers. They're literally going to the 10Ks, to the 10Qs, the quarterly reports, the annual reports. They're pulling in the data, and they're pulling it in from the generally accepted accounting principles. And unfortunately, GAAP earnings in the United States are sometimes very misleading. And the reason GAAP earnings can be so misleading is they include factors that totally throw off the earnings. So 3 of those factors that I have seen pop up with Johnson & Johnson are intangible amortization, special items, and tax charges. So intangible amortization, what is this? Again, I am not an accounting expert, but being an investor, being a dividend investor for such a long time, I've picked up a lot of knowledge around accounting. And intangible amortization, what this means is I'm J&J, I acquire some company, XYZ company, and this company comes with some intangible assets such as patents and trademarks. Well, what happens is when J&J acquires such a company, tax law and accounting law allows them to amortize these patents and these trademarks. And what that means is J&J paid a certain amount of money for this company. It comes with all these goodies, and they take the value of the patents, of the trademarks, and they literally amortize it over time, meaning they subtract it. It's subtracted out of the GAAP earnings. And so it makes the earnings look a lot lower than they otherwise would be, but it's not a real charge. It's a GAAP charge. It's not like J&J is going out and all of a sudden hiring a huge workforce, doubling their workforce and paying all these salaries. No, they literally acquired a company, they paid for the company, and they're allowed to amortize some of these items over time. So I'll get into an example of this in a minute to make it a little bit more concrete. The other one I've seen come up with J&J is tax charges. And so with tax reform, there's been a lot of tax reform under the Trump administration. And one of the biggies, one of the big changes is President Trump allowed these companies who had a lot of cash stockpiled overseas to bring it back, to repatriate, to bring it back into the United States. And he allowed these companies to do this at a lower tax rate than previously existed. A lot of these companies who had been stockpiling cash all around the world, they decided, you know what? This is a one-time tax opportunity. I don't know if it's going to come back again. I don't know how long it's going to last. I'm going to take advantage of what President Trump is doing here, and I'm going to repatriate my dollars back into the U.S. And so what happened for a lot of these companies is they did that just like J&J, and they took a big one-time charge. And so this one-time charge, yes, it's a real charge, but it's not indicative of the forward earnings of the company. It's a special item. It is something that happens one time. And so when that is taken into the earnings that are portrayed on Yahoo Finance, it makes the company look like it is doing a lot worse than it is. But again, it's a one-time thing. It doesn't affect things going forward. It is literally a one-time charge. And so anyways, what J&J does and how I get to the bottom of this is when they report earnings each quarter, they make it really easy. They report 2 numbers. They report the diluted GAAP earnings per share, but they also report an adjusted diluted GAAP earnings per share. So the adjusted one takes these factors out. It takes them out so it's easier to compare what the earnings per share really is without these special items. And so if I look at J&J, the last 4 quarters that they've reported are Q3 of 2018, Q2, Q1, and then Q4 of 2017. If I look at the diluted earnings per share over these 4 quarters, I pull it from their 10Qs, their quarterly reports, I get $1.44, $1.45, $1.60, and then a negative 3.99. They lost $3.99 in Q4 of 2017 because of tax reform. Anyways, I add all of these up, I sum them up, and my diluted earnings per share, GAAP earnings per share that I get for the last 4 quarters for J&J, it comes out to 50 cents. Now, this is weird because this 50 cents, it doesn't even line up with Yahoo Finance because they got 57 cents. More or less, it's in the ballpark. I don't know why that 7 cents is off. Again, the takeaway here is I like to use websites like Yahoo Finance. I love Yahoo Finance. It's probably one of my favorite financial websites on the internet. That said, I always verify. And so anyone, in my opinion, investing in dividend stocks in the stock market should always verify numbers and should always verify numbers at the source. And so I verify at the source, and what I get is a GAAP earnings of 50 cents for the last 4 quarters. Now, Thankfully, J&J makes it really easy for me. They also report an adjusted earnings per share, diluted earnings per share, non-GAAP number, and the non-GAAP number backs this stuff out. It backs out the intangibles, it backs out the special items, it backs out the one-time tax stuff, and it looks really at what the EPS would have been without these items. And what it has is $2.05 for Q3, $2.10 for Q2, $2.06 for Q1, and then $1.74 for Q4. I sum them up, and what I get is $7.95. So $7.95 adjusted EPS for the last 12 months is a lot different than 50 cents or the 57 cents that Yahoo shows. And this is fundamentally why investors are so thrown off with this company and a lot of other companies out there. When I take my $7.95, now I can approximate what the real numbers are. I take the share price, I divide by my $7.95. What is the adjusted PE on an adjusted basis? It's 16.35. 16.35 PE for J&J, that's a good PE. That's not bad at all. I love that PE. In fact, I would say it's trading at a fair, if not a discounted price at current levels. But if someone looked at it just looking at Yahoo Finance, they'd say 228, it has a lot more to fall, and they would be using bad numbers in, bad decisions out. Whereas down here, looking at it this way, it's good data in, good decisions out. And so it's always important to look at data at the source. Another example here is I take the payout ratio. I take my $3.60 per year that J&J pays in dividends. I love you, J&J. Thank you, thank you. $3.60. I divide it by the real adjusted earnings per share of $7.95. Payout ratio is 45%. Payout ratio of 45%. That's a lot better than a payout ratio of 632%. In other words, they are only paying out 45% of their earnings as dividends, meaning there's opportunity for J&J to raise the earnings even more over time. And so it is so interesting how looking at the wrong numbers can give a completely different conclusion than the right numbers, which one can find at the source. And so a few more things here. I have another column. I love how J&J does this. They make my job easy, but they also report year over year on a quarterly basis how their adjusted diluted earnings per share have done. And so I'm just looking at this column. I'm comparing it to another column that's not shown here, but they look at the year prior adjusted diluted earnings per share. In Q3, it grew 9.5%, Q2 11.5%, Q1 12.6%, Q4 5.7%. So you see, with this company on an adjusted diluted earnings per share basis, it is growing substantially year over year, and it's trading at a compelling value of about a PE of roughly 16. That, in my opinion, puts J&J into fair value territory, if not slightly discounted. I think it's a wonderful stock at these levels. I'll probably add some in 2019. That being said, it's not a strategic focus because it's already a big position in my portfolio. And I'm happy now just reinvesting my dividends while I build up some of my smaller positions. But I do like J&J at these levels. So a bonus tip, adding up all these numbers, pulling all these 10 Qs. In my opinion, if someone's not willing to go to those steps, I don't think it makes sense to invest in a stock. Because investing in stocks requires some analysis, especially on the front end. Once I own something on the back end, I don't really do as much analysis as a lot of other investors because I like to buy and hold forever. But on the front end, before I buy a stock, I will dig into all the numbers and all the 10 Qs, 10Ks, I'll know everything. And so I think it's really important for investors to take this step. That said, if people are short on time, they don't have a lot of time, a hack that I like to use is I go to Yahoo Finance, I go to the analysis tab, and I look at the consensus estimates from analysts, and I look at it for the current year, and this will allow me to back into a forward PE ratio. And a lot of the consensus estimates don't include this tax reform because this tax reform is really around Q4 of 2017. Anyways, if I look at the analysis consensus estimate for J&J for 2018, it comes out to $8.16. And so again, that's higher than the $7.95 because it includes Q4, which has not been reported yet, and it does not include the last Q4, so the company keeps growing. That's why the number is different, but that's just a quick hack. If I'm in a time crunch, I don't have a lot of time, you've probably seen this in some of my prior videos, I will look at a forward PE and I'll base it on consensus estimates, and the reason I do it is it doesn't include tax reform from Q4 of 2017. So moving forward, I want to show you how a thug looks at the quarterly reports. All right, so I've got my laptop here, MacBook Pro, of course. I am a shareholder in Apple, ticker symbol AAPL. Love those guys. Anyways, I wrote down some notes in here and I want to review them with you. I actually copied and pasted from their quarterly reports, and I want to show you exactly what I'm seeing when it comes to these GAAP earnings and the intangibles and the tax items. So for Q3, I'm going to start with that one. Q3 2018, it says net earnings and diluted earnings per share for the third quarter of 2018 were $3.9 billion and $1.44 respectively. Third quarter net earnings included after-tax intangible amortization expense of approximately $1 billion and a net charge for after-tax special items of approximately $0.7 billion, primarily consisting of non-cash charge attributed to a partial write-down of an in-process research and development asset associated with the acquisition of Alios Biopharma, Inc. Third quarter 2017 net earnings included after-tax intangible amortization expense of approximately $0.9 billion and a charge for after-tax special items of approximately $0.5 billion. Excluding after-tax intangible amortization expense and special items, adjusted net earnings for the quarter were $5.6 billion and adjusted diluted earnings per share were $2.05. So this is the type of fine print that I like to look at as an investor. It gives me a lot more information than what I'm pulling from Yahoo Finance. And honestly, after what I just read, not all of it is positives. This intangibles and amortization there seems fine. But one thing that I did see is there's a partial write-down of an in-process R&D development asset associated with an acquisition. That may or may not be positive. Honestly, I'm not familiar enough with the company to know if what that write-down is. But typically when I see the words write-down, it means they acquired something and it's worth less than what they thought it was. And so that oftentimes is indicative of a poor acquisition. But it did say with this acquisition, it's an in-process research and development asset associated with the acquisition. I guess I'd have to look at when they acquired Alios Biopharma and what happened with that. But anyways, I'm not trying to paint the picture that the adjusted diluted EPS is all good stuff. Sometimes there are, quite frankly, if I see a lot of write-downs, it is a red flag for me. Fortunately, I don't see a lot of those with J&J, but I think it is important that I can't just look at adjusted diluted EPS either. I have to kind of be in the middle ground. I have to look at both. But more often than not, over the last 12 months with J&J, I am looking at adjusted EPS, and I think it's more or less indicative of where the real business is. Here's another one. I'm going to go to Q4 of 2017. Net loss and diluted loss per share for the fourth quarter were $10.7 billion and $3.99 respectively. Fourth quarter 2017 net loss included after-tax intangible amortization expense of approximately $0.9 billion and a net charge for after-tax special items of approximately $14.6 billion. Bingo, that's what's throwing the whole thing off. Included in these special items is a provisional amount of approximately $13.6 billion associated with the recent enactment of tax legislation. Fourth quarter 2016 net earnings included after-tax intangible amortization expense, blah, blah, blah. Excluding after-tax intangible amortization expense and special items, adjusted net earnings for the current quarter were $4.8 billion and adjusted diluted earnings per share were $1.74. This is the most important nugget of information that an investor can find in the last year of J&J's operations when looking at EPS on Yahoo Finance, in my opinion. It's really that one-time tax write-off of $13.6 billion that just throws the whole thing off. Obviously, there's some intangible amortization throughout the year as well. It looks like there was a write-off, as I just mentioned, associated with Alios. There's probably some other stuff in there. if I look at the fine print even closer. But this is how I like to invest. This is the type of numbers that I like to look at. I think this is a really important video because, again, it is the difference between looking at something and seeing a completely skewed view versus looking at something and seeing a more realistic view. So I have some other companies in my portfolio as well that fall into this same bucket. The EPS looks really weird over the last 12 months, and so a piece of information just for everyone to take home is, generally speaking, I will not invest in a company unless it is sound financially. I will not invest in a company if they cannot cover the dividend. I will not invest in a company if I think the PE is out of this world, and so, in a bad way. And so this is so fundamental. One more bonus tip before I leave today is another way to look at all of this is also just to look at the cash flow. You can pull the cash flow from Yahoo Finance, also from their statement of cash flows, and looking at cash flow over time oftentimes gives a better picture than GAAP EPS, because again, GAAP EPS can oftentimes be so skewed by all this wacky accounting stuff that totally makes it difficult from an investment standpoint to understand what's really going on. What do you guys think about J&J? Do you like that stock? What do you think about it? I'd be curious. It's my number one. I'd be curious, what are your number one stock? What stocks are you looking at right now in 2019? Wish all of you an amazing 2019. And so I just want to take an opportunity here, quite frankly, to thank everyone in the community. We are almost 20,000 dividend investors strong. I cannot wait to hit that milestone. So thank you for your support. The best way you can support this channel is your likes, comments, subscriptions. All of that means the world to me. Before I leave today, in terms of full disclosure, I am long. I own the stocks mentioned today. I own Apple, ticker symbol AAPL, Johnson & Johnson, ticker symbol J&J, and 3M, ticker symbol MMM. I am long. I own all of those stocks in my personal stock portfolio. Also, before I leave today, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my personal journey here on YouTube for fun and entertainment. So please be advised of that disclaimer. Everyone, wish you an amazing 2019. I will see you in the next dividend investing video.